Tim and Mike, welcome to the SABM podcast.
Well, thank you. Thank you. Pleasure to be here.
Yep, it's an honor, Scott. Thank you. Thanks for having us.
Yeah, and I said before we hit record, I think this might be the first father-son duo on the SABM podcast. So after 350 of these interviews, congratulations.
Thank you.
Well, that's
Yeah.
pretty cool though. So
Yeah.
to be able to work together, and I know Tim, you're still, just got activated and that sort of thing. But, to have your father as a mentor for you in business and to kind of show you the ropes in real estate, I think is really a cool thing, and for Mike, for you to be able to pass that down to Tim, really special. So I just wanted
Yeah.
to share that and really
Yeah. Well, thank you.
excited.
Thank you, Scott. It's been a real pleasure.
Yeah,
It,
so maybe
it,
just to
re-
kick things off, SMB Equity is the name of your company, and would maybe just start off by sharing what you guys do, what you invest in. I know, just from your website, you've done over $3 billion of real estate deals. You've raised over $1 billion in equity. Something a lot of the younger guys and just people that even maybe have 10 or 20 years under their belt, something that they're striving to do. And so first of all, congratulations on reaching that level, but maybe just to kick things off at a high level, would love to learn a little bit more about your real estate
Yeah.
company and
Yeah.
what you guys invest in.
So, our firm started about 50 years ago with my senior partner, my partner today, Sherwin Gerald, who is 83 years old and still active in the business today. But he started this 50 years ago. He was a CPA and understood the nuances of real estate and the benefits of real estate and began putting small deals together. I started investing with him when I was chief financial officer for a division of ConAgra at the time. And I had put together a number of transactions with him. I just like I'm presenting to your team today, Scott. Basically, it was the same model 30 years ago, which is an alternative investment, investing in alternative different types of real estate. My first deal was a hotel attached to the Milwaukee Convention Center. Then we bought a office building leased to Chemical. Then we bought a another property that was a 1 million square foot building leased to Ames True Temper. And I was just participating, just like investors would be coming in today, as a passive equity investor in a separate LLC. We'll get a little bit more about the structuring of all of this a little bit later in the discussion. But I invested and I ended up having about 20 projects over 7 years with them. And then my time at ConAgra came to an end at their determination, not mine, but came to an end. And I was sharing with my then friend, Sherwin Gerald, and he said, "Hey, listen, why don't we talk? I think there might be something here for you." So we met, we had lunch. He said, "You want to join me?" And at that point in time, I had a year non-compete with what I was doing from ConAgra, and I thought, well, let's go for it. My personal background as a CPA, as a financial officer, two publicly traded firms and non-publicly traded firms. Also ran strategic planning, and I had real estate reporting to me in a couple of those firms. I knew all the, call it the vocabulary of the real estate business. So I thought I could be successful, but I didn't know I could raise any money. I'd never done that before in my life. So I said, let's give this a try. That was 24 years ago. And my first project I raised about $1 million for, and it was a large building in outside of Indianapolis. Was the very first project that I raised some money for, which turned out to be very successful. And so, over the next couple of years, Sherwin mentored me and how to do all this stuff. And I had the financial background, both tax and accounting, for my time with Price Waterhouse. And boy, I hit the market at a great time. I mean, the market, we were just blown and going and had great opportunities and did a number of deals. And we first started out in the industrial space, buying large industrial buildings. And we had projects leased to Ames True Temper, Preferred Freezer, Raytheon. I mean, it was a household collection of companies that we had bought real estate for under very similar models. With the plan of investing this stuff, kind of hold for 5 to 10 years, have a cash flow during the way, and hopefully a pop at the exit. And that worked out. That worked out very well. And we continued to do that over time. That process ran all the way through up until like 2008 during the Great Recession, and things got to be very interesting along the way. And the caveat, and Scott, I call it the grace of God and the little luck. We sold 65% of our assets in 2006 and 2007 before the Great
Oh, wow.
Recession. I
And why
have
why
no
was that,
idea.
Mike? Why was
Uh-huh.
that? Like what triggered what triggered you
I
to want to
woke up one morning and I said, this is getting too stupid easy. Money is too stupid easy to come by.
Hmm.
I walked in Sherwin's office and I said, let's try to sell everything. And here's my rationale. And he said, okay, let's do it.
Oh,
And
wow.
and we sold 65% of our assets in 2006 and 2007. And it's just the grace of God and a little luck. Why I was inspired to do that, I have no earthly idea. It wasn't any quantitative research or anything else. It just, I knew we could make some money and go from there. So we went through that process. We had a couple of very large transactions. We actually sold to Inland Real Estate Company, who put all this stuff in their REITs,
Hmm.
and carried on from there. We got through the end of that. Now it's 2008. The Great Recession begins, right? And we're going, oh boy, what are we going to do now? And so, we thought, well, we could sell the rest of it and quit, or we could keep going. I'm still a fairly young guy at that time, and we can keep going, or try to find something else. And we said, well, let's try to find something else. We kind of like this. So we started buying gas stations for all
Oh.
cash.
Oh, wow.
We brought, you're probably not familiar with this on the East Coast, but a number of quick trips, a Shell station, bought some dialysis centers leased to DaVita, a couple of medical office buildings. And then the market started to come back in, and we stumbled into this apartment sector through some friends in Iowa that ran one of the largest apartment operators. And we did our first venture in the fund in this apartment sector with what are called stabilized or existing apartments that are in pretty good shape, maybe a little tired, 20 to 25 years old, in good markets, buying below replacement cost. That with a little TLC and love, you have the opportunity to increase the rent $100 or $150 a month because you're upgrading the facilities. And if you look at the economics of that and the returns are all great on that stuff. And so we then proceeded down this path for really since 2008, and we've acquired over 50 apartment assets over that time frame, which is a large portion of our current portfolio. Our current portfolio of 60 assets has 40 apartment projects in it, and we've done quite well under that model. Along the way, you stumble across other things and other people. So there are different ventures that we found. Some are a little bit more risky than others, and we try to quantify the risk to people. And the stabilized apartment stuff is great, but it's got two investors. It's got internal rates of return that are 14, 15%. But some people like a little bit more risk. And if you mix this stuff in your portfolio, it's worth taking some shots at where you can approach 20 IRRs or better in certain things. That kind of gets us to this West Suburban Seniors project, which is very interesting and an opportunistic buy. But anyway, Sherwin's semi-retired. He's still active in the business. I effectively run the day-to-day management of this company. We have a staff of 12 people, of which we service. Believe it or not, because we've been around so long, there's 8,000 people in our database today. The
All
real
right.
core active group's about 700 or 800 people that are really core active. People so many friends I've lost along the way because life moves on and different things happen. And so we're always trying to look for new investors looking for bigger opportunities, looking to grow our asset base, introduce other people to the benefits of private equity investing, and in particular, the tax advantages of doing this. Because in these separate LLCs, you're able to throw off tax losses with positive cash flow during most of the length of these projects. And the resulting outcome is a capital gain on the back end, taxed at capital gain rates versus ordinary rates. So Scott, you think about this in these projects, you're getting cash flow along the way. You're getting tax losses, operating losses. Some people can use those immediately. Some they wait until the project is concluded. And then the tax implications of this stuff come out on the back end as capital gains. And you have the implicit differential of the vast majority of our investors. You've got over a 10-point spread between the ordinary rate and the capital gains rate, which makes a lot of sense, makes these things become tax efficient, theoretically adds a couple of points to the IRR if you actually do the math. So, and makes this stuff very attractive to do. My personal assets, I've got half my money tied up here in what we do. So, I put my money where my mouth is. I invest in every project. I use the same acid test of when I first got into this is, am I willing to put my own money into this? And I step into this stuff first.
Yeah.
So, you know,
Well, congratulations, Mike. And then Tim, when did you join the company, or how did that conversation
So,
go? Or would love to hear
it's
your
kind of
pathway.
interesting. I mean, my as far as a professional goes, my background is military aviation and now civilian aviation. However, that's not the background that I grew up in. I grew up around the dinner table as a family discussing what happened in the stock market, what's going on in the business world. That was our dinner table conversation. So I grew up around all of this stuff, asking a lot of questions, learning, some of it by osmosis and some of it just by being curious and interested. And then as I became an adult, and was watching, I learned that, especially as I got older, you get to see that people don't grow their personal net worth really by salary. It just the tax structure of our country makes that very difficult. And but growing your personal investment portfolio in a number of ways, you should have a very diversified set of portfolios, whether that's bonds and more stable assets, whether that's traditional equities, and then whether it's these alternative style investments. And I'm watching that over time, going, okay, what do I want for my family? What do I want for my future? And so when I was finishing the Air Force Academy, it's when I literally got my Air Force Academy loan from USAA that they offer, I think, to all of the Academy grads.
Yeah.
Everyone else is buying cars and things, and I'm like, I literally called my dad and said, "Dad, we got any projects coming up? I got 25 grand. Let's do it." So so I put that was my first investment in that would be 2004.
Okay.
And then I have invested in every project that my wife and I were monetarily able to, again, looking for a diversified portfolio. I mean, we have every kind of investment under the sun, including these. And so we've been investing in these for quite some time. And that eventually led to when I left active duty. So currently I'm still in the Air National Guard, still flying for the military occasionally. But in 2014 is really when I made the transition and had the opportunity and really joy to be able to start working with SMB in a real manner. So I started working mostly in investor relations, reaching out to a specific group of investors that are generally on the East Coast. Although honestly, as time has moved on, that net has widened and it's people all over the country. But we really depend on mostly word of mouth and experiential uh, uh, things in order to meet new investors. That's typically how we're shared. So, I meet a lot of people across all walks of life in my jobs, and we chat about what their life's about, what they're doing, and that's helped me sort of grow our business. And so along with doing investor relations, I also started doing risk management. Again, that goes a lot with my travels and with what I do in as a aviation professional. Being in aviation is all about risk management. Once you learn how to fly a commercial large airplanes or anything in that industry, everything is risk management based. Hey, I'm trying to accomplish something. What are the risks for accomplishing that? So that really dovetails nicely into reviewing and looking at future projects that we have at SMB. So I can take a look at a locale because I do travel the world extensively, and then also looking at the structure of investment itself and going, okay, what are the risks? What are the things we're not thinking of, and trying to pare those down to figure out ways to mitigate those risks. So, and of course, we do that a lot with our structure. Like Dad talked about, the LLC structure. And the language we write into our LLCs, protecting our SMB and protecting our investors is a critical part of what we do. And my professional career doing that has really helped me add something, I think, to SMB Equity. And then, like you were talking about in the beginning, being the chance to work with my dad has been a blessing, and just the mentorship and is off the charts. I mean, we've all had professionals we've worked with in our career. No one mentors you like a parent. They're going to tell you when you're wrong.
Yeah,
And
and they're not afraid to tell you.
they're not, and they're gonna correct you in a good way, right? Where you're gonna learn and go, okay, I need to learn and move forward and not make that mistake again, or not make that assumption again. I mean, like I said, we've all worked for different bosses and leaders and that sort of thing. Nobody out there will mentor you like a parent. So it's been wonderful. I quite enjoy it, and I love learning because it is something that by trade. I mean, I'll be quite honest. I have a degree from the Air Force Academy in history and a master's from Creighton University in negotiation. So kind of fuzzy-ish majors, if you will, in like the academy parlance. It's not business related. So I actually find it quite gratifying to engage my brain and learn and be engaged in something that is way different from what I was originally trained to do. I think it's great, and I enjoy doing that. So
Yeah, well, this is where you learn out on the street, making deals.
absolutely.
Mike, I'd like to, hand you the mic for a second. And, you've had a lot of at bats you've seen a lot of deals, probably thousands and thousands of deals. You've invested in, over 100. And I imagine you got a pretty good sniff test, and you can look at something pretty quickly, as I think a lot of investors can. Sure, we've got to go deeper and do our due diligence, but pretty quickly, you probably can tell, hey, this is one worth taking a deeper look at. Would you mind just kind of like walking us through, or what does that sniff test look like for you? Like if you look at a deal, like what's like the 5 second or the 30 second, thumbs up, thumbs down? Like, is that
Sure.
accurate? I'm guessing that you can probably do that pretty quickly.
And Scott, that's a very relevant question, because we probably look at 100 deals to do one.
Okay.
We scrub a lot of deals come across my desk every day. So it's, and a lot of this comes just because of my age and having touched so many people. We've now got a group of about, I call them 10 preferred partners. They call, I listen. They know our criteria. They know what we're looking for. They know that we're trying to, on a risk-adjusted basis, look for reasonable deals that have a high propensity for success. But then so first of all, Scott, maybe the first answer to all this, it starts with the people.
The partnerships, the strategic partnerships.
Yeah. Are they trustworthy? Are they good people? Are we going to be able to make this work? Not every project goes as you anticipate. So it really gets down to the quality of the people, that not only do you believe in the integrity of the projections that they're putting forth in front of you, their evaluation of that particular project and experience. But do they have the strength of character to work through the difficulty with you?
Hmm.
And so I think it first starts number one with people. Then you get into the economics of the deal. How does that look like relative to the market? What's our experience in that market? Have we ever done anything like this before? Have we tested the water before? Do we know people in the business that have tested the water before? So you get into all of the economics of a particular transaction. And in particular, Scott, where you have a transaction like this, where we're buying something at such a deep discount. I am a value hound with who I am. I look for value, buy low and sell high, right? How do
Yeah.
you do that? You do that with strategic partnerships that are touching things that other people don't see. It's where you can buy, and for instance, the seller of this particular asset, it's a short sale. They're coming to the table with money to close. We're buying something that has the potential residual value of $350,000 a unit. We're starting off at $30,000 a unit. That's a big spread. Yeah, a lot of work has to happen and take place, but the economics of that, when you break down the numbers and the money and the effort that has to be put into this, is there enough spread and cushion at the end of the day to believe that you have a reasonable probability of success and moderate risk? And I think that's where we're at in this project. So there's, starts with people, economic analysis, knowledge of the marketplace, depth of experience. I mean, I think all of those things are really critical that go into the analysis. And it's just not me. We have a team of people here that do this. I've got two junior partners with me. Junior, they're in their mid 40s, and CFO, as well as Tim on the committee, that we scrub these projects with, and everybody has a voice in that. We have a saying: if somebody doesn't like it, we don't do it. There's always another deal. So we tend to have, I think, discipline in what we do and how we go about it, and try to find great projects. But most of this comes through relationships. So
Yeah. Yeah. And I was thinking like, cap rates and what's the income of the property and what's, but that's, you said people. And I thought that that was really kind of an interesting, um, thing to share. But I mean, how true is that? I mean, I think that that's really interesting. And then you've built this alignment, multiple of these types of relationships that of people that you trust that, bring credible deal flow and are, if when
yeah,
the
and
crap hits
Scott,
the
listen,
fan, they're gonna,
in this real estate world, there's a lot of rascals. There are a lot of people that you just don't want to get involved with. So finding the right people to do this with, and yeah, you got to have the right cap rates, you got to have the right economics, you got to have the right RRRs, you got to have the right cash flow. You have those are basic things, but you got to go deeper than that. You got to look at the character of the people and their depth of knowledge and what they're trying to accomplish. And we don't screw around. When I commit to something, we do it. I have never committed to a partner to go into business with that we have not funded. So, with that, all of a sudden we have 8 projects with Justin Spalding in Wisconsin. We have 7 projects with David Mann in Westchester County. We have these John Kinselberg. I think we've done 6 projects with him. They keep coming back. Why? Because they know we'll close in this. We'll come in with the money. We do what we say we're going to do. We communicate. We try to become partners with them in these transactions. And so, to me, again, I just get down to the fact it's, yeah, you got to make all the economic hurdles work, but it gets down to the character of the people.
yeah. Well, let's talk through like a deal profile. I know you've got one that you're, that's active now, but I just kind of maybe, from a, just kind of like looking at the overview of a typical deal or maybe
Okay.
the current
Well,
one, like I'm curious, like, hey, how did it come
yeah.
about? Like, I'd love to just kind of learn a little bit
Well,
more about.
there's two real types, I would say. There's the development style, which I think Dad alluded to with the higher risk in those. And then there's the stabilized cash flow sort of style that we look. And those are, I don't want to say they're separate, but they're pretty separate styles of investment for us, because one, the stabilized cash flow is basically, hey, we close and next quarter, there are renters in it, say an apartment complex or a business type industrial asset, and it's throwing off cash immediately. You'll That's going to have cash flow starting from day one, and those will have probably a little bit more moderate returns. And then when we do a development project, we're looking for anywhere from 3 to 5 years. 3 years being about the shortest, and five is the average length of time where you have, hey, I've got an empty lot, or I've got a piece of property in a suburb or in a urban area that's got to be demoed, and we're going to build something on top of it. That scenario is there's no cash flow for the hold period, and then the cash is coming out the back end during the sale. But they both are packaged the same way. They're both packaged in LLCs. They both receive a priority preferred return for the investor, followed by a split of excess cash flow between the investor and SMB Equity. And so they're similar in structure, but one's going to have, the biggest difference is one's going to have cash flow the entire time, and one will not. So that's the two major differences between those two styles.
Yep. Let me add a few things, if I may, Scott. And again, I don't know the magnitude of exposure that the people that you interface with have. But let me just get down to a couple of just basic things really quickly. The structure of our transaction is limited liability company, taxed as a partnership. Every deal has its own entity, or sometimes multiple entities, but generally speaking, a single entity. We then collect money within that structure. Members are partners within that entity. They are limited liability partners. They have no obligation other than the money they risk and put up front, and that's specifically stated in the operating agreement. We file with the SEC on every project under a Reg D filing, and then we also file for every investor in every state that they're in. It's called blue sky filings as well. So that's the fundamental structure. Information comes out in a K1 format, similar to if people are investing in pipeline companies. They may get a separate K1 on a pipeline company type of transaction. Generally speaking, those entities, most real estate, because of the depreciation, throws off tax losses during the first 15 years, if you go that long, of its operating life cycle, and capital gains at the end with positive cash flow along the way. That's the basic operating structure of our entities. In terms of how we find projects, and I'll give you an example. So John Kinselberg is a very dear friend of ours. We've been doing projects with him for about a dozen of years. He's an apartment sector guy. He calls me one day and says, Mike, I've got this friend of mine, Lynn Jarrett. I think she's really doing some good work in the senior housing area. We met Lynn and her team about a year ago. She's got a project, and at that point in time, she was working on a number of things, including this Lombard project. But she also had one in Geneva, Illinois. And they were talking about, they were looking for additional investors. At some point in time, almost every person who starts out in this business runs out of friends and family that they can tap for money, and they're looking for an additional resource. Their choice is institutional, family office, other private equity firms. The problem with 1 and 2, they can be very difficult and very greedy in terms of their expectations, in terms of what to deal with. So therefore, many people gravitate to private equity, who are decent people who have interests that are aligned and see things and evaluate things the same way. We met with Lynn, we hit it off. They had a small project in Geneva, Illinois, which is in the far western suburbs beyond that. I personally invested in that project with her. So I wanted to test the water, which I frequently do before we start a new relationship. Project is done. according to expectations. The reporting's been great. Cash flow has been everything they've said. Project is doing everything they said they were going to do. We further become integrated. We meet their team. We meet with their partnership. We visit the property. We do a background search. We do all of this stuff based upon an introduction from a trusted friend. That leads us to a project. Project surfaces, the Lombard project. We go through the details of that. We really like that. Our team says, "Yep, it's a go." That's very typical on how these develop. So
Yeah. Yeah. And it takes time, right? It takes time to build those relationships. And, and you invested in one of her deals and, and so that took time to play out and then eventually, boom, you got it. It's, you find a
here
winner
we
and
are, Scott. Here we are.
here we are. So we're just kicking off the year here, 2026, just about to finish Q1. What are your guys's, most important goals, would you say, if looking out over the rest of this quarter, maybe in Q2, for the first half of the year, and then,
Yeah,
also like a moonshot goal, if you like had to look down,
yeah.
out over the horizon 3 to 5 years from now.
Oh gosh, Scott, I don't know. Uh, people have asked me that question, do you have all these objectives? And the answer is, we're opportunistic investors. We, there's there's been a couple of years when we didn't do a darn thing. And there's years when we do, I think the maximum we've ever done is 8 projects in a year, which is about our theoretical capacity and what our team can do. Um, I'm not looking to get any bigger at this stage of my life. I have a great life. I got great people around me that have been, they've all these, the 12 people in our office have all been with me a long time. Um, Half the time I kid them, they know what I want before I ask them uh, to do something for me. They, typically answers, "Oh yeah, we've already taken care of that, Mike." So, it's a great place to be. We all have good livelihoods. It's a fairly sizable empire to take care of. And at this point in time, Scott, I'm 70 years old. I'm in good health. I love what I do. I could have retired a long time ago. I don't know what I would do with myself. I'm not very good at anything else. So, but I enjoy mentoring Tim, my two young partners. One additional caveat, my daughter Kate is our CFO. She followed in my
Oh, wow.
steps as a CPA at Deloitte, worked outside for 8 years, got experience in the real estate business, and she's our chief financial officer and doing a great job at that too. So it's really become sort of, a very large family of investors. So
That's really cool. Tim, how
yeah,
about you, man? What are some of your most important short-term goals and then maybe, a longer-term goal as you look out over the
Yeah.
horizon?
I mean, I think over time, I'm about done. I'm about done with the military side of the house, so I'm looking forward to sort of wrapping up that part of life, and that will be expanding this part of my life, and so I'm looking forward to that. I would like to see us maybe be able to utilize technology to expand this our reach a little bit more. I think there is some future in that. I don't necessarily mean like Dad said. I don't think we're trying to get bigger per se, but I think we're trying to maybe make our what we do more accessible to folks. And I think we could do a good job of maybe doing a bit better job of that in the future. So that would be a pretty cool
yeah,
goal. I think that we could do on the horizon in the future. So
Yeah. And you guys have a lot of deals under your belt and a lot of experience. And for people to be able to leverage that, right? They don't have all those decades and decades of experience and the deal networks that you've built and those partnerships and to be able to offer that to
mhm,
people, and to build awareness around what you've built and the opportunities that you have available, I think would be a great service for folks. So,
yeah,
um,
yeah,
well,
it
cool.
would be
Well, I
that.
look, yeah, and
That
I
would be
look
a
for,
lot of fun. That would
yeah,
be that's very attractive.
yeah. And so, I know we're hosting an investor call with you guys in a couple weeks. So, for folks listening, if you'd like to meet Tim and Mike, be on the lookout for that email invite, and you're welcome to join us. Any parting shots there, Tim or Mike, before we wrap up? Anything else? Any questions I should have
I
asked that
will.
I didn't?
Let me start, Tim. We try to be very careful. I take this very seriously. This is people's money, and I do take this very seriously, and I've tried to maintain um, disciplined in our approach in what we do. I'd like to think that all of my partners here think along the same lines of valuing the relationships that we have for people. This is their hard-earned money. We're trying to open the doors to improving people's livelihood by giving them opportunities to do something outside of the stock and bond market. And I always tell people, alternative investments have a place, probably a small place in your overall portfolio. You still have to do the stocks, the bonds, the CDs, other investments, et cetera, et cetera. But I think private equity has an alternative place, particularly we can have a direct interest in real estate. And Scott, when I started investing, it was in the dot-com boom. And I didn't buy into that personally. And I started investing in this stuff during that time frame.
Mm.
Why? Because I could touch it. I could go visit it. I could go say, I own a piece of that building. I own a piece of this thing. I own a piece of that thing. I could touch it. I could see it. I could see the results. And it felt very tangible to me. And a lot of people thought, well, you're not very bright, Mike. This dot-com thing is just going to enrich everyone. And 4 or 5 years later, most of those guys say, Mike, is there something I can invest with you?
Yeah, yeah. Unfortunately, I got my academy loan in 1999, so that was great timing there. But
So,
I didn't invest in real estate, so I didn't have
yeah.
uh,
So,
you guys.
it's been good. And when you really understand the tax benefit that's been in place for a long time, I really think it's worthwhile for people that can't afford to do it to take some small portion of their portfolio and think about diversifying into these assets that have decent rates of return. I've always told people, Scott, at the end of the day, on average, we've got to deliver better than the long-term stock market average, which is 9 or 9.5%, right? So we got to do better than that, right? Otherwise, there's no reason for us to exist. And so that's overall what our objective is with our portfolio. I think we've been able to do that successfully. This is not risk-free investments. I don't pull any punches with everyone. We try to do our best for various reasons. We've had different flameouts. We'd buy a building leased to a strong tenant. All of a sudden, that business unit would get sold. The tenant would go bankrupt, and before you know it, we lost a building and only recovered 60 cents on the dollar. I mean, that happens. It's infrequent, but it has happened. Things can happen that you don't anticipate. It's Scott, it's always the things you don't know that get you in trouble. You can think through this stuff as best you can, but things happen in life that you don't always or can't always anticipate, and that can cause some distress. So, I do tell people, I think the best approach is try to do a number of these things. Take small bites and do a lot. And the most successful investors are those that have taken multiple positions over time and have just tried to build a portfolio over time and don't get enamored with any one deal. So,
Yeah, and
but
that's how you learn. That's how you learned, right? And I think that's how
absolutely,
you learn is you've got these maybe smaller investments and you've got them. You're in the game, and you see which ones do well and which ones don't do well, and which operators do well and which ones don't do well, and then you learn, right? And
absolutely.
you get better. So, what's the best way for folks that want to reach out to you guys and get in touch and learn more about what you do? What's the best way for them to do that?
Scott, my email, my cell is always on. I talk to people all the time. Tim interacts with an awful lot of people for me as well. So happy to speak with anyone who has an interest in this. We'll send them a detailed underwriting of our project if they have a particular interest in this one. I'll run through all the nuances of the project. Typically, I like to go through how I view the risk of that particular project. And what I'm trying to do, Scott, is I'm trying to understand people's perspective, and profiles are really interesting when you're talking to people. Some are saying, listen, I want to do this, but I want to do this very conservatively. Other people say, I really want to go for the higher return stuff. And I said, the higher return stuff's got more risk to it. When you're building something from the ground up, things will go wrong. Timing will go wrong, you know. And we've been very successful with ground up development. It's yielded better results, but there can be some pain along the way. So, you have to. I'm trying to assess and be fair with people in what's right for them, what they want to do. I want to make sure I don't do anything that's going to hurt anybody. So,
All right. And so what we'll do is we'll put certainly put a link to your website in the show notes, and then your LinkedIn profiles as well. We can include those so people can reach out to you there. And yeah,
yeah.
congrats on what you've
And,
built.
and Scott, if I may interrupt you, feel
Yeah.
free to put my email address.
Okay.
It's that is what I probably react to the fastest, and then from there we can set up individual meetings. I typically like to do a 30-minute with every new investor. I like to spend some time. I want them to understand how this works and all of the assets, the facets of this, how we approach things, what we do, the benefits of that, and I really want people to understand what to look for.
All right, gents. Well, it's been a pleasure having you on the podcast today, and it's been great, reconnecting and getting all of your updates and learning about your current projects. And well, here's to an awesome 2026.
Yeah. Well,
Yeah.
thank you, Scott. Thank you so much for
Thank
doing
you.
this. Really, really appreciate you and your time in this. Really, really appreciate you. Thank you much.
Yeah, your team is fantastic. So thank you. Thank you, Scott.